What's going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today, we're answering a question I get constantly, like all the time. Ryan, how do I actually find a home with an assumable mortgage? How do I even know if a house has one? If you've been listening to the show and you're sold on the idea of grabbing a rate in the twos or threes, but you're staring at Zillow like, where are they? This one's for you. Let's get into it. So here's the quick background. 3 types of loans are assumable: FHA, VA, and USDA. That's it. If a home has one of those loan types, the mortgage is assumable. It's written right into the loan documents. It's not a loophole. It's not a hack. It's federal law. The lender agreed to it when they issued the loan. So step 1 is simple. You're looking for homes that were purchased with an FHA, VA, or USDA loan. Now you're thinking, cool, I'll just go on the MLS or Zillow and filter for assumable mortgages, right? And this is where it gets real. This is the part that blows people's minds. Only 25% of assumable properties are actually tagged as assumable in the MLS. 25%. That means you're missing 75% of the assumable mortgages out there. 3 out of 4 homes with these killer rates, they're invisible to you if you're just searching online. Think about that for a second. Why? Because listing agents don't know about assumptions. Most of them have never done one. So when they list a property, they don't check the box that says assumable. They don't mention it in the listing description. They don't market it. That 2.5% rate just sits there hidden while the home gets marketed like every other property at today's rates. Here's what most people don't realize. You can't rely on the listing to tell you. You've got to dig, and there are a few ways to do it. First, you can look at when the home was purchased. If someone bought between 2020 and 2022, there's a really good chance they locked in a rate in the 2s or 3s. And if they used an FHA or VA loan to buy it, that mortgage is assumable. You can find purchase dates in public records, county assessor websites, tax records. It's all out there. Second, you can look at the loan type. Some MLS listings will mention FHA or VA in the financing section. Not always, but sometimes. If you see that, you know you've got an assumable loan sitting on that property. Third, and this is the big one, you work with somebody who's already done the homework for you. I maintain a list of over 1,200 assumable properties across Colorado, every single one. My team and I go through and identify which ones are FHA, which ones are VA, what the rate is, what the equity gap looks like. I've got a sublist of VA sellers on the Front Range who have already said yes, they'll leave their entitlement with the property. We call those hand raisers. I do all the heavy lifting to find those. Now here's a little hack for you. If you find a property you love and you're not sure if it's assumable, have your agent call the listing agent and ask. Simple as that. Hey, what type of loan does the seller have? Is it FHA or VA? Most listing agents will tell you, and if they say yes, you now know that mortgage is assumable whether or not the listing says so. But here's where it gets tricky, and I want to make this super clear. Some listing agents will say, no, it's not assumable. Some will say the seller doesn't want to do an assumption. And sometimes the bank will tell the listing agent it's not assumable. They are lying. Do not fall for it. Do not listen to them. If it's an FHA or VA loan, it is assumable. Period. It's in the loan documents. The bank doesn't get to decide. Do not take no for an answer. The banks don't want you to assume that 2.5% loan. They've got that rate on their books, and they would love for that money to be reloaned at 6.5% or whatever the rate is today. So they add friction. They make it difficult. They tell agents it can't be done. And agents who don't know better believe them. That's where we come in. We use assumption processors. These are mediators who know the process inside and out. They know exactly what paperwork the bank needs. And when the bank starts asking questions that aren't relevant or dragging their feet, these guys hold the bank's feet to the fire. Should we get FHA or VA involved? And the lender will instantly get in gear. Let me give you a real example. I had a client who found a property with a 2.375% rate. Beautiful rate, right? The listing agent had no idea the loan was assumable. We identified it, we made the offer, we got an assumption processor involved. The buyer used a second mortgage from Climb Credit Union to cover the equity gap, plus we negotiated $7,000 in inspection resolution. That buyer is now locked into a 2.375% rate, while everyone else is paying 6.5%. Let me put some numbers on that so you can see what we're talking about. Say you're looking at a $450,000 home. If you go get a brand new conventional loan at 6.5%, your monthly payment on the mortgage is about $2,900. Now, if that same home has an assumable loan at 2.5% with a $375,000 balance, your payment on that assumed portion is about $1,480 a month. Even if you get a second mortgage for the equity gap at a higher rate, your total blended payment is still way under what a conventional loan would cost you. We're talking $800 to $1,000 a month in savings every single month. That's a family vacation every year. That's maxing out a retirement account. That's the difference between tight and comfortable. So let me boil it down. How do you find an assumable mortgage? 3 ways. 1, look at when the home was purchased and what type of loan was used. If it was 2020 to 2022, an FHA or VA, you've probably got one. 2, ask. Have your agent call the listing agent and ask about the loan type. Don't be shy about it. 3, work with someone who already has the list. I've got over 1,200 properties identified in Colorado. My team calls every listing agent. We know who the hand raisers are. We know where the deals are hiding. And remember, 75% of these properties are not showing up in your search. If you're only looking at what's tagged in the MLS, you're seeing a fraction of what's available. Now, sellers, if you're listening to this, here's what this means for you. If your home has an FHA or VA loan with a rate in the 2s or 3s, that is your biggest marketing advantage. Whose home is going to sell quicker? This home that's selling for the same price and the buyer has to get a 6.5% interest rate, or this home that's the exact same and has a 2.5% rate and saves the buyer $1,100 a month? Which one sells faster? You tell me. Marketing your home as assumable brings in more buyers. More buyers means more competing offers. More competing offers means a higher sale price. Colin and Beth did exactly this. They marketed their property as assumable, got multiple competing offers that drove the price up. It works. All right, let's go find some hidden deals out there. I'm Ryan Thompson. This is the Assumable Guy Show. If you want to see what's on the list or figure out if an assumable mortgage makes sense for you, go to assumableguy.com or DM me on Instagram at theassumable.guy. I'll run the numbers for you. No pressure, just math. Next episode, we're getting into closing costs on an assumption, what you're actually paying, what you can negotiate, and why it's probably less than you think. See you on the next one.